Silver has never done this before. Not in 1 month, not in modern financial history. A metal that usually moves slowly and has just gone vertical. Silver has crossed $3,088 per kilogram. Gold is sprinting toward new records, and this is not a normal commodity rally. This is not about inflation alone. This is not about speculation alone. What you're witnessing right now is a shift in global trust, away from paper systems and toward real monetary assets, and that changes everything. I'm recording this on Thursday, January 29th, 2026, at 1:44 p.m. in New York City. Drop a comment and let me know what time it is where you're watching from. I'm always curious whether you're live with me right now or catching this later from a different part of the world. And real quick before we move on, I see in the analytics that a lot of you watch these macro breakdowns regularly but haven't subscribed yet. If this perspective is useful to you and you want more content like this, consider hitting the subscribe button. It genuinely helps the channel more than you might think. What makes this moment so extraordinary is not just the speed of the move, but its place in history. Silver has always been known as a volatile metal, but even by its own standards, what we are seeing now is unprecedented. In the past, silver rallies were typically spread over long cycles, punctuated by pullbacks, pauses, and periods of consolidation. This time, the market has skipped those steps. In a matter of weeks, silver has delivered gains that historically took many years to achieve. A single month producing this kind of performance is something that simply does not exist in modern price records. That alone tells us this is not a routine commodity upswing driven by supply shortages or seasonal demand. Gold's behavior alongside silver reinforces that message. Gold is not a momentum chaser by nature. It moves slowly, deliberately, and usually only accelerates when the global financial system is under visible strain. For gold to register one of its strongest monthly advances ever places this moment in a very small historical category. Comparable moves have previously occurred during periods of severe monetary disruption, when confidence in economic management was shaken and investors rushed to preserve purchasing power rather than grow it. When gold moves this fast, it is rarely about opportunity, it is about protection. The fact that both metals are rising aggressively at the same time is crucial. Historically, gold and silver do not always move in tandem. There are long stretches where gold advances quietly while silver lags, and other periods where silver speculates while gold remains restrained. When both metals align and surge together, it usually signals that the market is responding to a systemic concern rather than a sector-specific story. This kind of synchronization tends to appear when investors across different profiles, institutions, central entities, long-term savers, and short-term traders, are reacting to the same underlying fear. Another important detail is the nature of the price action itself. This is not a slow, grinding advance built on optimism. The movement has been sharp, one-directional, and relentless. Such price behavior suggests urgency. It indicates that buyers are less concerned about short-term valuation and more concerned about securing exposure before prices move even higher. In market history, that mindset typically emerges when participants believe something fundamental has shifted and may not easily reverse. Calling this a rally understates what is happening. A rally implies enthusiasm, momentum, and speculation. What we are witnessing looks far closer to a repricing event. Repricing occurs when markets suddenly reassess the value of an asset based on new realities, not new headlines. Once repricing begins, price levels that once seemed extreme quickly become normalized. That is why historic moves often feel uncomfortable in real time. They force markets to abandon old reference points. This is why context matters more than the headline numbers. Silver crossing record levels and gold accelerating at this pace are not isolated price achievements. They are signals embedded within the broader financial system. History shows that when precious metals move in this manner, they are reflecting stress elsewhere, stress that has not yet fully surfaced in traditional assets. In that sense, this moment is less about celebration and more about recognition. The market is telling us that something important has changed, and it is doing so in the clearest language it has: price. At the heart of this entire move lies a far deeper issue than inflation prints or commodity cycles. What is really driving gold and silver higher is a growing loss of faith in paper currency systems. Modern money functions on trust. It has value because people believe it will hold value, because governments promise discipline, and because central banks claim control. When that belief weakens, even slightly, capital begins to search for alternatives that do not depend on promises. Gold and silver sit at the very top of that list because they require no issuer, no policy backing, and no confidence in future decision-making. Over the last few years, global currency stability has been quietly eroding. Large fiscal deficits, expanding balance sheets, and frequent policy reversals have made long-term planning increasingly difficult for governments and institutions alike. When currencies are managed aggressively to solve short-term problems, their role as reliable stores of value comes into question. Markets may tolerate this for a time, but they do not ignore it forever. Precious metals often respond before the concern becomes obvious, acting as an early warning system rather than a reactionary trade. Another critical factor is the changing behavior of sovereign reserves. Around the world, there has been a gradual but meaningful reassessment of what constitutes monetary safety. Holding reserves entirely in foreign-issued paper assets exposes nations to policy risk, geopolitical pressure, and sudden rule changes. Gold, by contrast, carries no counterparty risk. It cannot be frozen, sanctioned, or diluted by another country's monetary decisions. As more capital seeks neutrality, demand shifts away from abstract financial instruments and toward tangible monetary assets. This transition is not loud or dramatic. It does not happen through press conferences or official announcements. It happens quietly, through incremental reallocations and long-term positioning. But when these shifts accumulate, markets notice. Gold responds first because it is the primary monetary metal. Silver follows because it occupies a dual role, part money, part industrial necessity. Together, they reflect a growing discomfort with a system that increasingly relies on debt expansion and confidence management rather than stability. The absence of a credible alternative currency further amplifies this effect. While global trade still depends heavily on dominant reserve currencies, there is no universally trusted replacement waiting in the wings. Digital concepts remain untested at scale, regional currencies lack reach, and bilateral trade arrangements fragment rather than unify. In that vacuum, gold resumes a role it has played for thousands of years, the ultimate settlement asset. It becomes the anchor when trust between systems weakens. This is why the current move cannot be explained by simple demand and supply narratives. Jewelry consumption fluctuates, industrial demand cycles ebb and flow. None of those factors produce synchronized, historic surges across both gold and silver. What does produce such moves is a collective reassessment of monetary reliability. When enough participants begin to doubt the long-term purchasing power of paper assets, the shift becomes self-reinforcing. Prices rise not because metals are suddenly more useful, but because currencies are perceived as less dependable. In essence, gold and silver are not being bought for what they might earn, but for what they might preserve. That distinction is crucial. Markets driven by preservation behave differently from markets driven by speculation. They move faster, they move with conviction, and they tend to persist longer than expected. This rally, therefore, is less about chasing upside and more about escaping risk. It is a quiet vote of no confidence, expressed through capital flows rather than words. Beyond currency confidence, another powerful force accelerating this move is the way markets are interpreting future monetary policy. Financial markets do not wait for interest rate changes to occur. They move based on what they believe is coming next. Right now, expectations around policy direction have shifted meaningfully. Even in the absence of immediate action, the tone of central banking has changed from aggressive tightening to cautious observation. That change alone is enough to move capital, because it alters the risk-reward equation across all asset classes. Interest rates sit at the core of precious metal pricing. When rates are rising sharply, holding non-yielding assets like gold and silver becomes less attractive. But when markets sense that rate hikes are finished and that the next phase is stabilization or eventual easing, the calculus reverses. Metals begin to look less like idle assets and more like strategic holdings. The current rally reflects this forward-looking adjustment. Investors are positioning not for today's policy stance, but for tomorrow's liquidity conditions. Another important signal lies in how inflation is being framed. When inflation is perceived as structural rather than temporary, it creates long-term uncertainty. Tariff pressures, supply chain restructuring, and geopolitical fragmentation all introduce costs that are difficult to reverse quickly. When policymakers acknowledge that inflation may persist even as growth slows, markets begin to anticipate a dilemma: easing policy risks, reigniting inflation, while holding rates high risks economic stress. Gold and silver thrive in that uncertainty because they do not depend on precise policy execution to retain value. Presidential and fiscal rhetoric also play a role in shaping expectations. Statements that tolerate or even welcome currency weakness as a tool for competitiveness are closely watched by markets. Even if such positions are later softened, the signal has already been sent. Currency strength becomes less of a priority than growth, employment, or debt management. That perception alone encourages capital to hedge against dilution. Precious metals respond quickly because they sit outside the policy framework entirely. History reinforces this behavior. Some of the strongest advances in gold and silver have occurred not during actual rate cuts, but in the period leading up to them. Markets tend to front-run policy shifts, especially when the macro backdrop is fragile. By the time rate cuts are officially announced, a significant portion of the move has already happened. The current price action suggests that markets are already discounting easier conditions ahead, regardless of the timing. At the same time, volatility itself is acting as fuel. Rapid price swings across currencies, bonds, and equities create an environment where traditional hedges lose effectiveness. In such conditions, investors gravitate toward assets with a long history of surviving regime changes. Gold and silver benefit from this reflexive behavior. As volatility rises, their role as stabilizers becomes more attractive, drawing in additional flows that further reinforce the trend. Ultimately, what we are seeing is not a reaction to a single policy decision, but to a broader shift in confidence about how effectively future challenges can be managed. Markets are questioning whether central banks can navigate slowing growth, persistent inflation, and rising debt without destabilizing currencies. That question does not need to be answered definitively for metals to rise. The mere presence of doubt is enough. This is why gold and silver are moving now, not later. They are responding to expectations, not confirmations. In financial history, moments like this tend to arrive quietly, accelerate rapidly, and only make sense in hindsight. By the time policy changes become obvious, the signal that mattered has already been sent through the metals market. Silver's outperformance relative to gold is one of the most revealing aspects of the current move. While gold is widely understood as a monetary hedge, silver occupies a far more complex position in the global system. It functions simultaneously as money, as a strategic industrial input, and as a scarcity asset. This dual identity is precisely why silver tends to remain subdued for long periods and then erupt suddenly when conditions align. When silver begins to outperform gold decisively, it is rarely a coincidence. It is usually a sign that stress is building beneath the surface of the economy. From a monetary perspective, silver acts as a high beta version of gold. It responds to the same loss of confidence signals, but with greater volatility. When investors seek protection, they move into gold first. As conviction builds and fear deepens, silver often follows with amplified force. This pattern has repeated throughout history. Silver lags during early uncertainty, then accelerates once markets begin to accept that instability may persist longer than expected. The current surge fits that historical behavior almost perfectly. At the same time, silver's industrial role adds another layer of pressure. Modern economies rely heavily on silver for critical applications, including electronics, energy infrastructure, and advanced manufacturing. Unlike many commodities, silver does not have an easy substitute in these processes. Demand linked to technological and energy transitions continues regardless of economic cycles, while supply growth remains constrained. When investment demand suddenly rises on top of already tight industrial usage, the imbalance can escalate quickly. Prices do not move gradually in such environments, they gap higher. This combination of monetary demand and industrial necessity makes silver uniquely sensitive to systemic shifts. Gold can be accumulated quietly by large institutions over time. Silver, by contrast, has a smaller market and thinner liquidity. When capital flows increase, the impact on price is immediate and dramatic. That is why silver rallies often feel chaotic compared to gold's more orderly advances. The metal simply does not have the depth to absorb sudden interest without repricing sharply. Another important factor is perception. Silver has long been viewed as the forgotten precious metal, overshadowed by gold in mainstream financial discourse. When silver suddenly captures attention, it often signals a broader awakening. Investors who once dismissed it as too volatile begin to reassess its role. That reassessment can be powerful because it brings in new participants at the same time existing holders refuse to sell. The resulting supply squeeze accelerates price movement further. Historically, periods when silver outpaces gold have coincided with late-cycle stress, currency debasement concerns, or structural economic shifts. These are not environments of comfort or stability. They are environments where traditional assumptions begin to fail. Silver's aggressive movement reflects that discomfort. It suggests that markets are no longer just hedging risk. They are bracing for prolonged uncertainty. In that sense, silver is not leading because it is fashionable, but because it is reactive. It responds to pressure points in the system that gold alone cannot fully express. Gold signals concern. Silver signals urgency. When both are rising and silver is accelerating faster, it implies that the underlying issues are intensifying rather than resolving. This is why silver's performance deserves special attention. It is not merely riding gold's coattails, it is amplifying the message. And that message, historically, has been clear. When silver begins to move like this, the forces driving it are deeper, broader, and more persistent than most market participants initially expect. One of the most dangerous assumptions investors make during powerful rallies is believing that rising prices automatically mean rising safety. History shows the opposite is often true. The faster an asset moves upward, the more fragile the short-term structure becomes. Sharp, one-directional advances compress decision-making, pull in emotional capital, and reduce margin for error. While the long-term story for gold and silver may remain intact, the path between here and there becomes increasingly unstable as prices accelerate. Parabolic moves change market behavior. Early participants tend to be strategic and patient, but late entrants are often driven by urgency. They buy not because they have studied the asset, but because they fear being left behind. This shift in psychology matters. Markets dominated by fear of missing out behave very differently from markets driven by conviction. Small pullbacks feel catastrophic, volatility spikes, and reactions become exaggerated. Even healthy corrections can trigger outsized damage for those who entered without a plan. Another layer of risk comes from leverage and short-term positioning. Rapid price appreciation encourages speculative activity, particularly in derivatives and leveraged instruments. These positions amplify gains on the way up, but they also magnify losses when momentum slows or reverses. When volatility increases, forced liquidations can cascade through the market, pushing prices lower far faster than fundamentals would suggest. This is how strong trends temporarily break, even when the underlying thesis remains valid. It is also important to distinguish between long-term value and short-term price. Gold and silver may be responding to deep structural forces, but markets rarely move in straight lines. Corrections are not signs of failure, they are mechanisms of balance. However, when prices move too far, too fast, corrections become sharper. Investors who mistake a secular trend for a guaranteed straight line move expose themselves to unnecessary risk. Timing and position sizing begin to matter more than the narrative. Another hidden risk is complacency. When an asset rises consistently, it creates the illusion that downside no longer exists. This is particularly dangerous in assets that are historically volatile. Silver, in particular, is known for violent retracements even within strong bull markets. Ignoring that history does not make it irrelevant. It simply increases the probability of emotional decision-making when the inevitable pullback arrives. Risk management becomes the defining factor in environments like this. That does not mean avoiding exposure altogether, but it does mean respecting volatility. Capital preservation should take priority over maximizing upside at stretched levels. The market does not reward impatience indefinitely. Those who survive long-term cycles are not the ones who captured every peak, but the ones who avoided catastrophic losses. It is also worth noting that elevated risk does not negate the broader message metals are sending. In fact, the presence of risk is often what confirms the seriousness of the underlying shift. Stable systems produce stable price action. Unstable systems produce volatility. The current environment reflects the latter. Recognizing that distinction allows investors to stay engaged without becoming reckless. Ultimately, rising prices are a signal, not a guarantee. They tell us something important is happening, but they do not tell us how smooth the journey will be. In moments like this, discipline matters more than enthusiasm. The greatest mistake is not being wrong about direction, but being unprepared for turbulence along the way. When viewed in isolation, the surge in gold and silver can look like just another market anomaly or an exaggerated reaction to short-term news. But when viewed in context, it becomes something far more meaningful. This moment represents a transition. It reflects a world moving from an era of relative monetary predictability into one defined by fragmentation, uncertainty, and recalibration. Precious metals are not causing this shift, they are responding to it. The global financial system has operated for decades on a framework built around stability assumptions, reliable trade flows, predictable policy responses, and a shared confidence in institutions allowed markets to function smoothly. That framework is now under strain. Geopolitical tensions, supply chain restructuring, and rising fiscal pressures are testing the limits of coordination. As these pressures accumulate, markets begin to price not just current conditions, but future fragility. Gold and silver act as mirrors to that process. What makes this moment distinctive is that the signals are coming from multiple directions at once. Currency markets, bond markets, and commodity markets are all reflecting elevated stress. Precious metals sit at the intersection of these forces. They respond to currency dilution, they hedge policy uncertainty, and they provide continuity when financial narratives shift. Their rise suggests that participants are no longer confident that traditional tools alone can manage the challenges ahead. This does not imply an imminent collapse or an inevitable crisis. Markets are rarely that binary. Instead, it suggests a prolonged adjustment period. During such periods, capital seeks assets that are resilient across scenarios rather than optimized for one outcome. Gold and silver fit that requirement. They do not depend on growth, political alignment, or technological dominance. Their value is derived from scarcity, durability, and historical acceptance. Another critical aspect of this moment is how quietly it is unfolding. There is no widespread panic, no dramatic headlines declaring the end of the system. Yet prices are moving as if something fundamental has changed. Historically, this is how major transitions begin. The signals appear in markets first, long before they enter mainstream discourse. By the time the narrative catches up, the repricing has already occurred. This is why precious metals are often described as insurance rather than investments. They do not promise outsized returns in stable environments, but they become invaluable when assumptions break down. The current move suggests that more participants are seeking that insurance, even if they cannot yet articulate the risk they are hedging against. That collective behavior speaks louder than any single forecast. Importantly, this moment also challenges long-held perceptions. For years, gold and silver were dismissed as outdated or unnecessary in a modern financial system. Their resurgence forces a reconsideration of that view. It reminds markets that progress does not eliminate cycles, and innovation does not remove uncertainty. When complexity increases, simplicity regains value. In the end, what we are witnessing is not a temporary anomaly, but a reflection of deeper realignment. Gold and silver are signaling that the world is entering a phase where stability cannot be taken for granted. They are not predicting disaster, they are pricing resilience. Understanding that distinction is essential. Those who recognize it early can navigate the transition with clarity, while those who ignore it may only understand its significance in hindsight. When metals move like this, history tells us one thing clearly. Something bigger is changing beneath the surface. You don't need to panic, but you do need to pay attention, because once the reason becomes obvious to everyone, the price is already far higher.